Good evening, ladies and gentlemen. This is Barry Norman on behalf of FXTM and Investing.com, and welcome to our webinar, Understanding Charts. Tonight's class is sponsored by Forex Time, FXTM, one of the world's leading online broker and platform providers. They've been named Best Broker, Best Forex Broker, Best Top Customer Service, all awards last year, and they've got more awards coming online this year. They are well known and well renowned in the industry. They are a regulated provider, so you know when you trade with them, everything you do is monitored by the government and within the regulation, and you're protected at all times. They offer an extreme array or big array of promotions and tools and services to help you trade more successfully. And once again, as I say, they're licensed all over the world, and they only provide services in the jurisdictions in which they're licensed. They have outstanding education, and they will help you master Forex and CFD trading. So when you trade, why not trade with a winner? So tonight, we're going to be looking at understanding charts or building your roadmap to success. Because charts are one of the most basic tools that any trader should understand. Now, charting isn't that complicated. Learning how to read a Forex chart is considered to be somewhat of a science, but it really isn't. It's pretty easy, but you need to understand them. Because at first glance, they do look complicated. Forex charts can look drastically different depending on what options you use, what type of charting service you use, what background, what colors you've selected, because you can customize and personalize charts all you want. Now, charts usually have settings for display styles of price and time frames that you want to view. Time frames can be anywhere from some expensive charts at 1 second intervals to 10-year intervals, depending on the chart service you are using. Now, charts are your basic foundation. It is one of the crucial things that you have to learn to start building your roadmap to success. Because whether you're going to trade from technical analysis, whether you're going to trade from your charts, whether you're going to build whole charting strategies, is completely up to you. But no matter how you're going to trade, nothing's going to tell you when to enter the market at what price, where to put your stop loss, where to put your take profit points, what the swing of the markets will be. That only comes from charts. So whether you're trading from the Federal Reserve announcement today, or you're trading from press releases, or you're trading from stock reports, still nothing's going to tell you at what point to enter, where the markets swing, and give you crucial trading numbers. Now, charting isn't hard. It's just something you have to get used to. And it has to become part of your trading life, so to speak. Now, charts come in 3 different formats. And these are the basic formats. Almost all, there's lots of variations. But all the variations are based on these 3 types of charts, which are line charts, bar charts, and candlestick charts. And they're not all that different, and they're not complicated. Now, with a chart, the chart is your blueprint. It helps you lay your foundation. It helps you start your building process. You can then add all the details you want, and the more information you put on your charts, the less likely you are going to get lost or make a big mistake or take a big hit in the markets. Now, the first type of chart is a basic information chart. It doesn't give you any great detail, and it's called a line chart. Now, a line chart is very simplistic. If you're looking, right now we're looking at the Euro-US dollar chart. You can see it in the background here. And we're looking at a 30-minute time frame chart. What that means is that at the end of every 30-minute period, at the close of that trading period, a dot is put on the chart. And then those dots are connected to form your line chart. Pretty simple, isn't it? That's only a line chart. A line chart gives you a general visualization of how the market is moving or how the asset's moving. But it shouldn't be traded from because it doesn't have enough information for you. From the line chart, we go to my favorite, which is the bar chart. Now, what we're looking at is the bar chart for the same time, for the same asset, for the Euro-US dollar 30-minute as you were looking at on the line chart. But as you can see, the bar chart gives you a much better visual understanding of price movement. And that's what charts are. Charts are visual depictions of price action. So what you see in each one of these lines, or each one of these bars, contains a lot of information. It contains so again, we're looking at the Euro-US dollar 30-minute chart. So every 30 minutes, a bar is put on the chart. That bar gives you the open of that 30 minutes, the close of that 30 minutes. It gives you the highest point it traded at in that 30 minutes and the lowest point that asset traded at in that 30 minutes. All in this easy to see visual story. But once you've got your chart in a visual format, or once you're looking at a visual, you can start to see a lot of other pieces of information. Like here, look at that. We can see all the highs were the same number. It tells us something about the price. We see that visually. We can see here we have congestion and we don't have much action in that price. Here, when we see the downtrend, we can actually see some common price points. Okay. We can see when we draw a support line underneath. Look at that. When we draw a support line, look at all the times that that price hit that support line about, because we're visually seeing price in an easy to display format. Now, the bar chart is my favorite type of chart. Now, each one of these lines or each one of these bars tells a story. We put a little doohickey to the left at the open of the period we're looking for it. If you're, okay, and you could be looking at a 10-minute chart and you'd have one of these every 10 minutes. If you're looking at a one-day chart, you'd have one of these bars every 1 day. If you're looking at a 1-hour chart, you'd have a bar for every 1 hour. So you would put a doohickey to the left at the open of that period. You'd put a doohickey to the right at the close of that time period. You would put a dot at the highest price it hit during that time period, and a dot at the lowest time it hit at that time period. So you have the open, the high, the low, and the close. And a bar chart is sometimes referred to as an OHLC, open, high, low, and close. Now, we simply draw a line from the high to the low. And that gives us our bar. Now, when we step up, like climb up the ladder from the open to the close, that's a bullish time frame because the bulls dominated that time segment because they were able to push the price up from the open to the close. When we opened higher and we closed lower, so in other words, we stepped down the ladder, that's a bearish time frame because the bears controlled that segment of time. So the bar chart tells you a lot of information in a visual format. Now from here, we go over to what has become the most popular type of chart, and that's the candlestick chart. Candlesticks have only become popular in more recent years because of computerized charts. Now, candlesticks have been around since the 1700s. They were developed by rice traders in Japan. But candlesticks are a complicated trading or charting system. They are very, very much like the bar chart, except you color in the bodies of between the open and the close. And because they become a buzzword in retail trading, they have lots of traders trading from candlesticks. And as you can see on the chart in front of you, this is the same asset we were looking at before, the euro US dollar, in a 30-minute time frame using a candlestick chart. Well, what happens is too many newbie traders and novices think that candlesticks are about the reds and the greens. Or they can be black and white, they can be orange and blue, whatever color you selected. But the standard is reds and greens. And they think when you see a lot of red on the chart, you should be trading an asset going down. When you see green on the chart, you should be trading an asset to go up. But to be honest with you, it got nothing to do with candlesticks. Candlesticks are a complicated charting system that when you learn it and you put the time and the effort into understanding it, can be very helpful in your trading. But it means you must learn how to use candlesticks, because we're all human beings and we let these colors color our psyche and let us make decisions when this is not what they're telling us. Candlesticks are all about what's called the body of the candle and the wicks of the candle and the shapes of the size and the size of the candles, the shapes the candles make, and their relationship to the candle before and after it. So they've got strange names like harami, marabozu, doji, but each one of these are patterns that you have to learn. And these tell you something about what you can expect in the market. And then it's the position of that candlestick in relation to the previous. Like what we're looking at here this is called a star candle because it looks like a star above the previous price. Okay. We see candles like this which are considered called doji because the open and the close were almost the same. Okay. And you have to learn what all of these mean. They all have names and interpretations. But if you do, it's a very valuable way to trade. But these are the three basic types of charts. So we have line charts, bar charts, and candlesticks. But a candlestick, to form each one of those candles, we put a line across at the open. We put a line across at the close. We put a dot at the high, a dot at the low, and connect those to what's called the body of the candle. And then if we stepped up the ladder, we fill it in with our bullish color or green. We step down the ladder, we fill it in with our reddish color. Now, when we do this, what does that remind you of? The bar chart, open, high, low, and close. Okay. So what's the difference? The bar chart just doesn't have the colors, and it doesn't have what we call wicks. But it covers the same time frame, the same movement. Now, there are as many different ideas of what you want to do on charts as there are traders. You can decide on your own what type of chart you want to use. But then once you've decided what type of chart you want to use, you have to then start figuring out what you want to do with this chart. Now, we were looking at a 30-minute time frame. The time frame is how much time went on between each one of those lines you put on the chart. And then, of course, when you're looking at your chart, if a chart can hold 50 lines in your view screen and you're looking at a 1-hour chart, you've got 50 minutes of 50 hours of time. If you're looking at a 15-minute chart, you only have 50 of those is, 3 hours, 5 hours worth of time. So it's what you're seeing on the chart, and also your time frames should be tied back to the type of trading you're doing. Because if you're trading short-term trades, like most of us do in CFDs and Forex, and you're looking to be in and out of the market within a day, you'd be more concerned with how an asset's moving over 15 minutes because you want to get it at the lowest price of the market and get out at the highest. Where if you're looking at, if you're a swing trader and you're looking to hold on to an asset for 30, 60, or 90 days, yes, everybody wants to get into the bottom of the market, but you're not dealing with the daily movement and the daily swing of the marketplace. So each of the different time frames can give you clues to the personality of the trading pair. You can find out whether the pair tends to move steady during its trends or if it tends to stall often. You can find out if it's volatile during daily sessions but steady over weekly sessions. Like if you look at the one-day trade today of the euro-US dollar, well, when the Feds came out with the rate decision, okay, and they were more hawkish than expected, before the rate decision, the dollar fell. The dollar recovered it all. If you look at it in a one-day chart, you'd see virtually no movement for the euro-US dollar because you'd see lots of swing of volatility, but it ended up pretty much where it started at. But if you looked at it in 15-minute segments or half-hour segments, you'd see lots of action. Okay, so viewing a currency pair in multiple time frames can help you find good entry and exit points depending on the strategy you want to use. Day trading a currency can make a lot of sense for traders to take advantage of daily volatility, but keeping the daily trend in mind can help day traders focus on the bigger picture. So let's go over and take a look at the charts and see this in real life. So hold on, let me pop up some charts on your screen. So if we were to look, this is the euro-US dollar, and we're looking at it in a bar chart, and we're looking at it on a 1-hour chart. So euro-US dollar, 1 hour. Now each charting service is slightly different, but they're all basically providing the same stuff. So, and today the nice thing is you can jump from candlestick charts to bar charts by just flipping a button. It doesn't change anything you've done. And you can change the time frames by just clicking on a number. So you can decide and see multiple things. So now, if we're looking at the euro-US dollar today, just over the little short while since right before the Federal Reserve announcement and through the Federal Reserve announcement and Janet Yellen's speech, what do we have? We saw the euro shoot all the way up here. That means the dollar got very weak before. Then we had the interest rate increase and the statement that was much more hawkish than expected. So what happened was the euro-US dollar is back right where it started. So when we're looking at it in a 1-hour chart, we see all this volatility. If we change it to a 15-minute chart, look at how crazy that volatility is. But if we now go over to a one-day chart, let me just get my markings off of here, we see virtually nothing. Because for the whole day, it ended up where it started. But if you were going to trade the euro-US dollar today, you sure wouldn't want to be looking at how it traded in a one-day period. You wanted to look and see how it was trading in a much shorter period of time. So time frames are very, very important. The other thing about time frames is it gets you a better perspective on an asset. It lets you understand its personality. For instance, you could see by looking at different time frames that maybe if gold falls during the Asian session, it recovers in the European session. If it climbs in the Asian session, it usually gives back its losses in the European session. And you can see how it trades while both sessions are open. And you can start to see that on using when you overlay different time frames, you can start to get comparisons. Now, the other thing is we saw the euro go sky high today, then come back down to where it is about 112. Well, that gives us a perspective of today. We look at it in the long term. We look at, say, the euro has been trading pretty flat. But when we change that perspective over, we realize the euro is in the middle of a huge downtrend. And it's just slightly. So now we're looking at a 4-hour, and that tells us, look at that uptrend. Well, that only takes us back, a couple days ago, okay, or about a month ago. Okay. Now, when we go back, so we would say the euro is trading in a very steep uptrend. But if we go back to a 1-week chart, Look at what we see about the euro. It's actually in a sideways movement, but after a huge significant downtrend. So it's trading towards the bottom of its trading level. If we go back to a 1 month price, okay, we see something else. Look at that. We can see the euro was trading at this level, 15 years ago, recovered, came back down, and is back down to where it was 15 years ago. But we also start to see some significance around today's prices and those same price points that it was hitting when it was in 2001. And we can see that this line is on right now, this 112.95, 112.97 was significant in 3 other time frames over the last few years. So that tells us something about the current level and the current price that we're looking at. And this is called support and resistance. These are prices over the past where the asset has hemmed and hawed. The asset has sat at before, where these prices were significant to traders in the past. And we only get this interpretation from charts. Yes, you may read it in an article from Reuters or MarketWatch that tells you, yes, the euro, if it falls below 112.92, it should fall down to its next support level at 112.85. But where did that guy who's writing about it get it from? He got it from a chart. There's no other place to get this except from your charts. And what your charts are is a visual story of price action. And it's an easy thing for us to conceive and understand. If we want to use candlesticks, all we have to do is click on the chart pattern and click on candlesticks. And now we have candlesticks. Now, the reason we need to understand charts is because they give us the basics. They're the bare basic root of what's called technical analysis. So hold on, let me go back to our PowerPoint. Let me pop that back up on our screen. Okay, so Forex trading attracts many different types of traders with many different types of systems. If you want to trade a currency pair, it's best to become as familiar with it as possible. Viewing the currency pair in multiple time frames is part of the process of learning its personality. Understanding the currency's personality will help you in your success with trading. But one of the best reasons to learn how to chart properly is so that you can apply technical analysis. Now, the fact is, not every trader believes in using technical analysis, or not every trader wants to put the effort into technical analysis, because it can get very complicated and very overpowering, and it can be very complex. Okay. But even if it's not your primary trading method, the basics of charts and 2 other pieces of tools should be part of your tool belt. You should never make a trading decision without looking at your charts, a trend line, and your support and resistance. Okay. Because these are not, even though they're the basics or the foundation of technical analysis, they're not very complex. They are what, this is what a builder needs, or an architect needs before he can start the blueprints. And then he makes the blueprints, and then the builder needs to lay his first block perfectly square, or else the whole building is turned on an angle. Well, these are the bare basic building blocks. Okay, so whether you're trading from a speech by Tim Cook from Apple, or whether you're trading on earnings report by Citibank, whether you're trading on the Federal Reserve action, okay, without looking at a chart, you'd have no idea where to put your stop loss. You'd have no idea where to take profit. How would you know how high an asset should go, or where you should be leaving the market to book your profit? Okay. How would you know when it's moving up or down where you should worry, where it's areas of congestion, where the market's telling you that maybe it's top heavy, where it's telling you maybe you should get out? How would you know what to do? How would you know when to enter it? If I said to you, okay, Apple's going to go up, I guaranteed you Apple was going to climb. But I didn't tell you what point to enter the market. So when you called your broker and Apple was trading at, I don't even know what Apple's at, but say Apple was at 145 when you called your broker, you said, yeah, buy me 1,000 shares. But when I told you Apple was going to go up, it was down at 136. Apple happened to go up $9 before you called your broker. And then 10 minutes after you got off the phone with the broker, Apple went back down to 136. And then it climbed up to 140. So I was completely right, but you lost your shirt. Okay. Somebody just type in here, you cannot see my picture. If you can't see anything on your screen, you need to log out and log back in. It's not on my side, or refresh your computer. Now, a chart is basically a roadmap. Okay. Now, way back when, before we had GPS, and I used to travel for business, I had a business partner who we used to travel together with because we make our calls. He was a chemist and I was a salesperson. And when we would go to make meetings, if I was going alone, I'd ask for some directions, and then I'd end up for sure getting lost. I'd have to leave an hour ahead of time, and then I'd get off the highway at 3 different filling stations and ask for directions. I'd always make my meeting on time because I always left more hours than necessary. Now, they might tell me to get on this highway, get off at that exit, turn left at the filling, and I jotted on a piece of paper, and that's all I did. Where my partner was an expert, he'd get out the road atlas out of the glove box, and Peter would be able to tell me, go to the roundabout, take the 3rd exit off the roundabout, go past the filling station, go down to the school, turn left when you get to the 2nd light, and then when you get to the mall, turn to your right again, and the parking lot will be right across the street from where you want to go. And we'd never get lost because he could read and understand all that detail on the map. Me, I still look at maps and get confused. Even when I look at Waze or you look at my Google Maps, it's all too much for me. I can deal with sticks. But charts, I can look at everything. But a chart is just like a map. And the thing about charts is, look, we were looking at the chart of London or the surrounding area of London right there. And here's a chart of natural gas. They almost look the same. A whole bunch of squiggly lines that tell you absolutely nothing. Except if you know what each one of the lines means. If you know what each one of these colors mean, if you know what it means, all of a sudden, you can understand it. Now, I can look at this chart and I can tell you exactly what I'm looking at. I can tell you what it's saying. I can tell you, I didn't make up this chart. I just copied and put it in here. But I can interpret this entire chart. Why? Because I've been doing charting for 40 years. Now, on the other hand, nobody expects you to do charts. But the thing about charts is you can set them up. And when you set up your chart and you put the lines on yourself and you can set the color lines and you do it yourself, all of a sudden, it's not you reading a road atlas. It's you drawing the map the way you draw the map. And you can get there because you understand what those colors and what those lines mean to you. And again, a chart can be as simple or as complex as you want. You can add on all the technical analysis, or you can use just a bare foundation. But every person who's trading needs to use a chart, needs to look at price action on a chart. Once you put price action on a chart, you need to be able to put 2 more things on a chart. And one is a trend line, and the other is called support and resistance. Because these aren't really part of a trading system. They're not really strategies. They are the bare pieces of information that every trader needs to have to make an intelligent decision. Now, a trend line, as well as showing the direction and strength of the current price movement, trend lines also show potential support and resistance of the trend. The future support and resistance of the current price movement are very valuable pieces of information. There are several trend line trading systems that are based on just on support and resistance. But that's if you want to get into a trading system. But when you put your trend line on your chart, it will tell you where you can expect price to move. Now, trend lines don't tell you where to enter the market. They don't tell you where to exit the market. Trend lines can be broken at any time. But trend lines have very strict rules because a trend line is very important. Now, a chart is simply reporting data. So your candlestick chart or your bar chart is only reporting the actual price data. Everybody in the world has that same exact price data. Everybody has the same candlesticks, the same bars, the same everything. Okay? Because price is price is price. Now from there, everybody should have the same trend lines. Okay? Because you're not trying to outsmart some guy around, halfway around the world. What you're trying to do is interpret what price is moving and where you should expect a reaction to price. And once you've determined what everybody else around the world is looking at, you can then start making decisions. Because as you can see on this uptrend here, if you had drawn this correctly on the chart, when price came down here in this candlestick, at this price level, you were expecting some type of action. You were expecting price to bounce off of that trend line. Now, when it did, you can then make some decisions for yourself. But if you had drawn your own trend line on here, not following the rules, and you decide the trend line should be here, guess what? You were expecting price action there, but you got no price action because nobody else in the world had drawn a trend line like you did. So they all were reacting here when you were expecting the action here. And when you can predict, again, you can't predict what the action will be, whether it will go through the trend line, whether it'll stay above or below. You just know at 135, 835, you should get some type of reaction. When you get that reaction, you can then determine what that reaction was and then determine what you might think will happen with that asset. Now, trend lines are one of the most basic concepts of day trading or long-term investing, and they also are one of the most powerful concepts. Trend lines have been used for trading for as long as there has been markets. And they are well suited for any type of market, whether it's stocks, currency, commodities, futures, ETFs. Trend lines are based on the idea that markets move in one trend and then the opposite. Trend lines show the general direction of price movement, the strength of that movement, and where future resistance and support will be likely located. Trend lines show three distinct but related pieces of information. They show the direction of price, uptrend or downtrend, the strength of the movement, in other words, how steep that trend is. And lastly, they give you the support for the current movement. Trend lines are straight lines that are drawn on graphic price or indicator charts. Now, it is possible to draw trend lines between any points on the chart, and they often look pretty damn good. Yeah. Okay. In fact, one of the issues I've been working with for new traders is that they will say, I drew this line and I like it. I can draw any line I want. Well, yes, of course you can. But the question is, how do you draw a line that is meaningful, that will both best respect volatility and integrity of whatever trend is in effect? So there are standard ways that you draw these trend lines. When you draw them correctly, you can predict the market. And this is why we have classes that are called The Trend is Your Friend, because it takes you about an hour to master, but that's it. You can master trend lines, and you can have short-term trend lines, medium-term trend lines, and long-term trend lines. So like before, when we were looking at the euro, we see that it is a long-term downtrend, a medium-term uptrend, and a short-term downtrend. So that tells you something more about that. And when you can see crossovers between uptrends and downtrends, you can actually predict where you expect, what you can expect out of the markets. So here, let's go back and look at that chart again. So let's go back and let's go look at a 30-minute chart. And we can see that the euro basically has been trading in congestion. Let's take out of the scenario the Federal Reserve action, because that was an outside circumstance. And as you can see, before the results, the price went up, then it came back down, ended up right where it was. But we see that the euro has been trading in over the last week or so in a congestive area in a very tight range. But we can see it's in part of a more recent downtrend. Okay. We can see that here. So we're in a short-term downtrend because this only takes us back a week. When we go back a little bit farther, we can see that it's actually trading in a medium-term uptrend. Okay, now it traded higher, but over the long term, it's trading in an uptrend. Because you got to remember, you as a short-term investor are only concerned with short-term moves. But if I had bought $1 million of the euro a month ago, and I'm looking for a couple percent increase, and I've seen it move from the end of May to this level in June, and I bought it down here, I'm very content because I'm a swing trader. I'm not a day trader. Okay. Or if you're a long-term investor and you were buying euros for your long-term portfolio, okay, and you had bought them, up here, okay, again, it depends on what type of trader you're. Just like if you bought gold. If you bought gold 15 years ago and you bought $1 million worth of gold and put it in the gold vault, okay, and gold moved from $396 to whether it's at $1,300 today or $1,282 or $1,290, you're not looking to sell it. All you're looking for is you're very happy if your portfolio increases 15% a year. Well, gold went from $396 to $1,300. You've got over a 15-year period, you got a nice increase in your money. You're not looking to sell it, so you're just looking for that steady uptrend. So by understanding the trends, and it all varies on what type of trader you are, what you're looking for. Are you a trader or investor? Are you a day trader or a swing trader? Are you looking for short-term profits or longer-term profits? So all of this is derived from your charts. Now, once you've got your trend line on a chart, you can then put what we call support and resistance lines on your charts. Okay. And you can start doing more complicated analysis of price movement. Here, we're looking at the Euro Swiss franc today. And look at this, we had a beautiful downtrend with a beautiful trend line on here. We had a soar in the our moving average. We also had a doji with a test candle, and this gave us a very good entry point. And we would have bought here for the Swiss franc to go up to here based on our resistance line at this price level, our support line here, and we would have entered the market at this price and waited for it to go here. And we've combined this with our RSI and other indicators to make a determination. But this is all using complex technical analysis. Okay. If we would have been making other reasons and other uses of a chart, but you can start adding onto your charts. If you're able to put your support and resistance line, your trend lines, and then add a third little key to it, which is called volume, you actually have the basis of a full trading system. Because volume, let's go back to my first chart. Okay, volume can be dropped on the chart, and the bottom indicators and information are just dropped on. I hate when it does this. I'm in my account and it tells me I need it. Let me just add volume on here. There we go. Okay, volume is simply the trading volume. Volume should move with price. So if you have trend, price action, support and resistance, and volume, volume supports the trend movement. Okay, if traders believe in that price movement and the price is moving up along that trend and volume's increasing with it, that means the price should continue going up. Okay. When you reach a support and resistance number, support and resistance come in lots of fashions, and we have whole 1 hour classes in support and resistance. But support and resistance are prices that are significant to the market. And like I showed you here, one of the ways of doing support and resistance is what I call eyeballing. And we can see that this price here, let me actually put a straight line on here for you. This price here is very crucial. Look at all of these tops that just hit that price level over the past trading, the last month of trading. So 112.37 is a crucial point for the euro US dollar. We can find, and that is what's called a resistance line. Every time price moves up to that line, it tends to bounce off of it. It's a place where buyers hem and haw. Then we can also find a price underneath. And all it is when you eyeball is a common price. And look at that. All the way back here, we see how price bounced off there, price bounced off here. Price came down and touched this line here, bounced off of, price came down at this little low, bounced back. So we know that 119.53 is what we call a support level. Whenever that asset's moving down, it would most likely touch that line and bounce off. Doesn't mean it won't break through. But look at this when we've isolated these prices. Look at this whole trading scenario that holds true to those price levels. So we have support and resistance. We have, if we had a short-term trend line on here, if we knew the rules for drawing trend, as well as volume supporting that, we might say, okay, whenever price moves down to this level and volume supports it, we're going to trade that asset to go up. So if you would have entered the market each time this price hit that level, you would have had a lot of successful trades. But these are just the bare bone tools you start with charting. Is understanding time frames, the different types of charts, and 3 pieces of information you need to be able to see before you make any trade, no matter how you're going to make a trade. But one of the most important reasons for learning to use charts is so that you can add to it what's called technical analysis. And technical analysis is all types of indicators and oscillators you can drop that are dropped on your charts that help determine where price is moving. So if we want to put on here, say, RSI or stochastics, so all we do is scroll down here, we come to Relative Strength Index, and it's an oscillator, a bounded oscillator that tells us something, but it falls below your chart and works in relationship to the price on the charts. Then we can add things like MACD, moving average convergence and divergence, okay, and again, that works with our charts. So you can see here that we've used these all together to film and build a trading system on our charts. Again, you can use the bare basics or you can use the more complex. You can learn one and keep adding to your charts over time. But you need to be able to look and read charts and tell a story, at least in how price is moving. In other words, when I come home each day, I sit down and in 5 minutes I can look at 10 charts and I don't need to know I don't need to read what the Federal Reserve said today. I can look at my chart and tell you, I don't need to tell you word for word. I can tell you, yes, we had a rate increase. Yes, they were hawkish because I can see how the markets reacted. I don't need to know the fine words that Janet Yellen said. I need to know what the market action was, and I have to be able to look at a chart and tell this pretty quickly. So charts just tell you a story. And the more you use and the more you get to know them, the better you build your roadmap to success. And on that note, I'm going to say goodnight to everybody. Thank you for joining us. And make sure you come join us for our class, The Trend is Your Friend, and Support and Resistance. And then before you know it, you'll be using charts on a regular basis. Have a good night now. Thank you for being part of FXTM and investing.com. And if you go to www.fxtm.com or forextime.com, you can open up a demo account, start using their charts, and we'll thank you very much, and we'll talk to you soon. And for you guys, I'm not here to give you tips. I'm not here to give you trading advice. I'm here to teach you. So don't ask me to give you some tips on employment change, unemployment coming soon. Okay, I'm not here as a trading advisor. If you want, contact your account managers, and they'll be glad to tell you how and what is to expect in the marketplace. Have a good night now, and we'll talk to you again real soon.